Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. Today I want to discuss the benefits and drawbacks of using financial ratios. Now this was one of the questions that someone had asked, I think maybe 2 weeks ago, and we didn't get to it, and I want to use this time to get to it. And we can also discuss what ratios I'd look at probably in a separate video. If you want that one, feel free to let me know in the comments below. But first, let's just talk about what a financial ratio is, how people use them, and how they can help you make a better investing decision. So basically, it is a shortcut, and it's a shortcut that we pull from specific company statements or even the stock price. And basically, we can say we can compare the stock price to how much money the company is making, and that is commonly known as a PE ratio. And what these ratios do is give us context to say whether or not company A is undervalued or overvalued. If it's undervalued, perhaps I want to buy this company. If it's overvalued, perhaps I'll wait until the price comes down, or perhaps I'll go to a different company or a different industry altogether. The benefit is it can give you very quick, easy decision making. If it's above a certain number, if it's below a certain number, boom, I can buy it. I know that I hold a company that is solid. I know I hold a company that is considered to be undervalued, and in time, that investment should grow. That's the easy part. That's the benefit of doing it. The drawback, though, is there are a lot of times where you can buy something that checks all of the ratio boxes and it still doesn't perform well just because the market doesn't like it. That does happen. Nothing is a guarantee here. The other thing too is that depending on which ratios you are using, that some of these ratios can be manipulated. And I say that because remember, we are pulling a lot of this information. When we say earnings, when we say profit, when we say debt to income, we have to go to the balance sheet, see how much debt they have, divided by X, Y, and Z, and it spits out a number for you. Well, you can manipulate some of those things. Like when we say profit, right, there's something called depreciation. And I can say that, well, my van is worth less because I drove it off the lot and it's a year older. That's an expense. Therefore, I'm more profitable based on how I'm cutting these numbers. And you know, there's a case for it in accounting, but in finance and these ratios, it may not actually make sense. So always know that some of these numbers can be manipulated, but not in like a nefarious way, not in a bad way. It's just the nature of that ratio is not looking at a specific thing. It is comparing these two things or these three things and nothing else. So it doesn't always give you that context. Another example, you can take a company like Netflix. You can take, I know I keep picking on Netflix. You can take any number of companies and the ratio could give you a specific number, but it's not telling you about subscriber growth. It's not telling you about what's going on in Russia and Ukraine. It's not telling you all the other contextual things that come into play that might make something cheaper. You could say, let's say the chip shortage, let's say the supply chain shortage. Well, a ratio, we're comparing, price, the company's stock price to earnings, and the stock price comes down, it feels more attractive. But is it more attractive because of the business and the financials behind it, or is it more attractive just because it's struggling right now? The ratio by itself is not going to tell you that. So the best thing to do is to compare several ratios together to get a better picture. Better thing to do is to read up more about the company, understand what's going on with the company, and then make an informed investment decision based on the ratio and several other factors. I'm actually writing an article on this. Whenever it comes out, I'll let y'all know. So we'll see after the editors kind of take a look at it. All right, so I want to give you an example of how this can work and how you can kind of compare these things and how they work in real life. So for example, and I can go deeper into detail in the members only later this week, but for example, let's take a company like Progressive, and I took out some notes here. So what I'm considering right now is price to earnings growth. This is PEG ratio, and what this does is it tells us how much are we paying for this company in comparison to how much it is growing in terms of profitability. So you made some money this year, you made more money the next year, so on and so forth. So what am I paying for that? Right? Am I paying a lot for this or am I paying a little for this? Is it undervalued? Is it overvalued? So in most cases, you want to have a PEG ratio, a PEG ratio of 1 and below. 1 is fairly priced, anything below that is even better. So the PEG ratio for Progressive, as of the time of this recording, we're doing this on the 17th, is 1.71. It's a little bit overpriced. However, you always want to do everything in context. If I look at the entire insurance industry and its competitors, the entire industry, it is at 2.05. So the entire industry is overpriced, but in comparison, Progressive is underpriced. It could be more attractive based on this one ratio. Not everything, just this one ratio says that it might be undervalued compared to everything else. Therefore, someone may decide to buy it based on that. Again, you want to have more context. Another example here is Campbell's Soup. These are all stocks that we've talked about, the CPB. Its PEG ratio is 5.99. That's high. Remember, I want something in an ideal scenario between 1 and 0. And it is 5.99, extremely high. When I compare that to other things in this category, other stocks in this category, it's at 2.47. So in terms of a deal, and Campbell's Chicken, I keep saying chicken soup, Campbell's Soup, or just Campbell's, is doing incredibly well as a stock, but it is, by this definition, overvalued. There are other values out there in terms of what I'm paying for it. Can I get a better value somewhere else but not make as much money? Yes, that's a downside to ratios. And the last one here is Pepsi. Pepsi has a PEG ratio of 3.31. The entire category, which includes Coca-Cola and others, is at 3.12. Pepsi is slightly overvalued according to this one metric. So it all depends on what you are looking for as an investor, and then deciding how it compares to everything else. If I'm looking at something like Pepsi and Coca-Cola, they're basically not necessarily mirror companies, because Pepsi makes more snacks and products, but that's an example, right? The PEG ratio doesn't tell me that they also own Frito-Lay, and that when we talk about soft drinks, that's not the only thing that Pepsi does, whereas the only thing is Coca-Cola does. So are they equivalent, and how am I properly evaluating the two? So that's just wanted to get the conversation out there, and then ask you, what ratio do you want me to cover? Do you want me to give you a top list of 3 to 4 that I like and use? What's going to be most helpful for you? But I just want to get out there, give you the pros and cons, and we'll take it from there. All right, if you want to learn more about investing, you want our deep dives, you want our breakdowns, feel free to check out the members only. All right, that's it for me. I'll talk to you later. Bye.